Good afternoon, everyone. We are Team 5 and we are going to be presenting a case on BL investment management. So, this case revolves around Ripero, who is a CFA, who's having a conversation with two of his CFA colleagues regarding a three plan structure, creation of CID account, advisor compensation scheme, and sales and distribution agreement with the Prodigia Group. Our team has recognized 5 critical scenarios throughout the caselet, and we will be going through all of them.
So starting with the CID account, clients were led to believe that the account was all-inclusive with an annual fee covering, based on their AUM value, and this covered administrative, management, and trading costs. However, in reality, mutual fund fees were not included in this coverage, yet Bianchi marketed the account as including all trading commissions, or all fees including trading commissions. And then she also included every type of client into the CID account, regardless of their client profile, being such as more conservative buy and hold clients who were just, their needs were just ignored, basically. So, and with that, suitability was violated first, and they prioritized AUM clients first, and ignoring the whims or the wills of different types of clients. Fair dealing was violated, directly due to the high AUM clients being prioritized, and then misrepresentation was violated in marketing this account as all-inclusive while excluding the mutual fund fees, and then loyalty and prudence was violated with prioritizing the high AUM and not prioritizing family accounts.
Thank you, Gunnar. Now I'll talk about the second change that the firm made, which was in terms of advisor compensation scheme. Here the firm increased the variable component of the fees from 25% to 75%, and they included a year-end cash bonus if the employees achieved at least 10% increase in the revenue. Now the violations that I'm going to talk about here are, so whenever the independence and objectivity standard gets violated in any firm, it is the duty of the employees to make sure that the clients are communicated with the conflicts that are going on inside the firm. So clearly, by increasing the variable pay structure from 25% to 75%, the firm did violate the standard of independence and objectivity, and thereby violating avoid or disclose conflicts as well. Along the similar lines, the company also violated communication with clients and prospective clients because they nowhere mentioned about the change in the fee composition from 25% to 75%. Now lastly, loyalty, prudence, and care. Since the change in the fee composition could actually give an incentive of focusing on short-term gains to the investment managers of the firm, they might not be willing to take into consideration the risk and return characteristics of the clients, thereby violating the standard.
BLIM did an agreement with Prodigia in exchange of their client data to provide to market and promote the shares of mutual funds from Prodigia's products, and they were provided $5 million compensation, which they did not disclose to their clients. And because of that, violations occurred, and standard 6A was violated by Ribeiro because he did not disclose the conflict of interest that happened because they did not have the agreement disclosed to their clients. Standard 6C was violated by Ribeiro and his teammates because they accepted the referral fees without disclosing, having it in written disclosure to their clients. Standard 3E was violated by Ribeiro because he did not preserve the confidentiality and shared the client data with Prodigia Group. Standard 5A was violated by Juan and his teammates, advisors, diligence and reasonable basis because they did not conduct proper due diligence that should have been conducted. Instead, they should have disclosed the conflict of interest with the clients, provided them that and they should not have provided the client data, and they should have done a proper due diligence before recommending their products to the clients.
So BL Investment Management created an internal class selection matrix to assign mutual fund share classes to clients. The clients did not receive this explanation. Instead, they received a simplified fee schedule. And this resulted in a 35% increase in firm revenue. So these actions violated 3 different standards. First, they violated standard 3C under suitability. They failed to consider each client's individual investing needs when making these decisions, which prioritize firm revenue over client success. Secondly, they violated standard 3B under fair dealings because the clients with lower assets under management were unable to see the share class fee structure. They were uninformed to make a proper decision. Lastly, under standard 1C under misrepresentation, the matrix omitted several key factors, creating a false sense of objectivity and fairness. Our recommendations are to ensure that mutual fund share classes are assigned to clients based on their individual risk profile, and that advisors offer consistent service across all clients, regardless of how much revenue they bring to the firm.
Here I'm going to talk about arrangement with fund manager. So basically, clients were encouraged to use Class A shares instead of Class W shares because Class A shares offers higher fee, and fund manager benefits from that. So they made a mutual understanding between the fund manager and the firm so that both of them benefits from each other, and they let the clients' priorities go away. So there are a few violations that was made due to the arrangement. So first, I want to talk about priority of transaction. So here, priority of transaction is not violated because although Diego got insider information from Lopez, he actually told to the client before making trades on himself. So it is not a violation of priority of transaction. But it violates material non-public information and market manipulation because the information that Lopez shared to Diego was insider information and was not known to the common public. And at the same time, NAV, the net asset value, was actually already calculated and trades were made based on that, which is again insider information. Market manipulation is also violated here because and the NAV, the transactions made through NAV actually distorts the prices when they make huge buy or huge sell deals. So we recommend that we have a strict information barrier between the information, between the fund manager and the firm, so that this kind of information is not passed between the both.
So these issues, looking broadly, show basically a failure of knowing the law, and they violate specifically the Financial Industry Regulatory Agency or Authority FINRA's 2111 rule, which mandates that recommendations for clients should be suitable for the client's needs, and that rule was ignored in prioritizing client based on their AUM value. And then Rule 10B-5 of the Securities Exchange Act was violated through Diego and Lopez's insider training.
If I had to talk about the responsibilities of survivors and conduct as CFA members, so as a supervisor and a CFA charterholder at the same time, firstly, Ribeiro did not set the good tone at the firm. He ignored all the possible warning signs at the firm, and lastly, did not comply with laws like FINRA 3110, which basically mandate supervision authorities in the firm, thereby violating these standards. So here we have the 5-part solution.
So we developed a 5-step remedy to solve these ethical failures. First, we want to establish compliance oversight and ensure audits and we have oversight over our advisors to ensure this behavior doesn't happen again. Secondly, we want to have transparent client communication. So we want to ensure all clients are on the same page and are all have the same amount of information.
Next is H, which is harmonize incentives with client outcomes. It is okay to have compensation based on variable outcomes, but it must be ensured that clients' outcomes and client suitability are being considered while taking a decision for the firm. Next is I, which is implement independent product review. So we saw that a mutual fund, Prodigy mutual fund, was actually recommended to the client without actually taking into client's recommendations or client suitability into consideration. So they should have implement a product review, independent product review, where it actually benefits the clients, and also it does not it actually benefits the clients. And the final one is continuous ethics education, which is very important recommendations that we give forward, because all the employees need to know what is ethical and what is unethical. So we recommend that we actually the company actually gives a regular workshops based on real life scenarios and case studies, so that they actually can implement it in the real life. Thank you.
Okay, great. great presentation. Well done. You were talking about a firm fee, placing a firm fee ahead of client success. And I guess my question is, if they're all in the same mutual fund, which is buying the same securities, whether it's A share, C share, or W share, how does that impact the client? Aren't they getting the same success in any one of those shares because they're invested in the same names?
So basically, like different, all the class shares had the same, all the criteria, but only the fees was different for each of them. So I think if here they actually like recommended using class A shares because it offers higher fee and it actually like benefits the fund manager. So they must ensure that they actually like go with all the recommendations that they had in the class matrix.
So as far as the negotiating, just the agreement with Prodigia, what could they do differently as far as to onboard that fund manager, and have done it right?
So there was nothing problematic with the agreement of $5 million with Prodigia, the sales distribution agreement. It's just that the company should have made sure that the clients are also aware about it, and along with favoring the Prodigia company, they should have made sure that they should have taken into consideration the risk and return characteristics of the clients that were the part of their firm. So yeah.
Lopez and Diego, when you're talking about the material non-public information section of the presentation, there was also a part of the case that allowed clients who purchased Class A shares to buy and sell their shares of LAFX at current day's closing price instead of following day's closing price. Was that in violation of any CFA standards, and what should have been done differently?
Okay, so the case study clearly mentions that this closing day NAV price was disclosed to the clients by the fund manager, Herbert Lopez was the name. So he should not have done that because everyone in the market should have an equal opportunity to act on the information, and this basically gave them an edge over other investors who are there in the market. So to go rightly about it, the fund manager Herbert Lopez should not have conveyed that information to these clients at all.
So to add on to that, usually the prices are traded, like the next day prices are taken into consideration while trading. So these people, they are like Lopez gave information to them beforehand, which is not available to the common public. So it is a violation.
What's you mentioned the suitability and not prioritizing the family accounts. What's wrong with letting the family accounts go last?
Because every client should be treated equally, and because they are family, they should not be treated indifferently and taken at last. Because they are also the clients of the firm, they should be treated equally. That's the problem.
Thank you.
As far as Riviera, I know you mentioned at the end, identifying that there's definitely a lapse in him being a supervisor. What are some of the specifics and what are of what can be implemented in the firm to kind of help mitigate kind of a lapse in supervisor judgment?
So it is the duty of the supervisor to have a close watch on all the activities that are going under his department. Ribeiro clearly did not do that because he was actually the one who committed most of the violations in the first place. So he was nowhere making sure that the people working under him were not committing anything.
And he also wanted to benefit and get involved in that insider trading himself, which also brings into question his competence, I would say.
So maybe like people, like members in the firm can have like they can be told what is the violation. Like if somebody has violated, they can have a portal where they actually tell what the violation is without identifying themselves. So that would really help help the firm notify like who has actually violated.
All right, thank you.
Good job.
Thank you.
Thank you.
Thank you, team. Guys. Great job.